Hi, and welcome to Brett's Corner, where we cover everything small business. From how to start a business, to how to grow your business, to how to keep your books, and ultimately how to position and sell your business, and some things to think about after you've sold your business. If you're a small business owner, or you're thinking of being a small business owner, you're in the right place. My name is Brett Husselball, and I've been a small business owner for over half my career. I started my first small business in 1995. I quickly grew that one to over multi-millions in revenue, and I sold that to a Fortune 500 in 1998. I started my second small business in 2000. I grew that one more slowly to over $1 million in revenue, and I sold that to a multi-billion-dollar corporation in 2014. And now I'm retired. And what I like to do here at the Corner is to share the benefit of my experience with you. So, before we begin, a quick disclaimer. Number one, I'm not an attorney. I will share with you some of the experiences I've had regarding legal issues and what worked for me, but what worked for me may not work for you. If you have specific legal questions, consult an attorney. Number two, I'm not a CPA, nor am I a certified financial planner. But like every business owner, I know my financials, and we'll talk financials, and I'll share with you some of the things that you should know. But if you have specific financial questions or tax questions, consult a professional. Same goes with investment questions. Consult a professional. So, with that out of the way, let's get on to today's video. Hi, today I'd like to talk to you about exit strategy, how to exit your small business. Now you may think, hey, I just got started. Why do I want to exit? Or I love what I'm doing. Or that's so far in the future, I'll think about that when that day comes. But I can almost guarantee you that day will come, and you will want to exit your business. And when that day does come, wouldn't it be nice if you can get something out of your business that you think is worthwhile rather than just have to walk away from it? A recent Forbes article that I read said of the businesses that put themselves up for sale, only 20 to 30% of them actually sell, and that most business owners do not have an exit strategy. I can say this. If you wake up that day and you say, you know what, I need to exit the business. If you do not have an exit strategy, it's too late. You need to have been thinking about that years ahead. It takes years to get your business into a position where you can sell it. So let's talk about the reasons somebody might want to buy you. I've had the good fortune of being able to start from scratch 2 different businesses and sell both of them to large corporations. And so from my personal experience, there may be many reasons, but from my personal experience, there are 4 main reasons why someone might want to buy you. Number 1, they want your customers, they want your geography, they otherwise want you. They can merge you into their existing business and quickly increase their revenue by a significant amount and or their reach. They want your existing up and running business because you are strategic to them. Number 2, and this is why my first business was acquired, they want to eliminate you as a competitor. I was starting to dig into the market share of my largest competitor, and it was easier or quicker or cheaper or less risky for them to buy us and bring us into their fold than to keep competing with us on the marketplace. They want to eliminate you as a competitor. That's also a strategic reason. Number 3, you have something they want, usually intellectual capital. You've developed something. You own a patent, a manufacturing process. In my case, my third company, we developed a software package that the company wanted to acquire. And it's less risky, cheaper, and faster for them to acquire you than to try to develop it on their own. That is also a strategic reason for an acquisition. And then finally, number 4, you have someone who wants to be a small business owner, now has the capital to buy a small business. They'd much rather buy an existing up and running successful business than to go through the risk and the headaches of the startup phase. Those 4 reasons, reasons 1, 2, and 3, are strategic. Now, reason number 4 is non-strategic. So here's a rule. If you want to command a multiple of your annual revenue as the sale price of your business, your sale must be strategic. If you want to command more than or a multiple of your revenue, your sale must be strategic. Otherwise, expect no more than book value. So what is a multiple of revenue? Well, what is your annual revenue? Then take a number and multiply it by that. 1 times, 2 times, 3 times. That's a multiple of revenue. That's a sale price, a common sale price of a company, but it's a strategic sale price. Book value, what's that? We covered that in a previous video. Go look at your balance sheet. It's the equity you have in your business, your assets minus your liability. That's your book value. Unless you're an asset-heavy business, for instance, you might own and manage a bunch of rental properties, in which case your business is probably asset-heavy. Your book value exceeds your annual revenue. But for most businesses, that's not the case. Your annual revenue far exceeds your book value. And book value is a non-attractive number for most business owners. So if you want more than your book value, you must be strategic. So how do you make yourself strategic? The most important thing you need to do is to build intrinsic value in your company. What does that mean? Your company must have value all by itself. Number one is it needs to run without you. And that's very hard for a lot of entrepreneurs. A lot of small business owners have a difficult time building a company that runs without them. It means hiring people. It means trusting people, empowering those people, letting those people manage their specific areas and make their own decisions and actually spend your money as their budget, their annual operating budget. It means putting in infrastructure. It means putting in accounting systems and tracking systems and costing systems. That's a lot of things that have little to nothing to do with probably your main core business, and that's what the entrepreneur is usually good at, and it has everything to do with management of a business. A lot of entrepreneurs struggle with that. But if you want to create intrinsic value, if you want to create a business that runs without you, you have to be able to do those things. Otherwise, if the business does not run without you, and I want to acquire you, first of all, if I come in and I do my due diligence on you, I'll quickly figure out that your company won't run without you. I'll figure that out quickly. And secondly, if that's the case, then it's cheaper for me to just hire you. Why do I want to buy your company? I want you. I want what you bring to the table. Obviously, now I figured out that that's really what your company is. It's you. So at most, I should be expecting to pay your salary of what I could get someone with your skill set on the open market. I may be willing to go as high as book value with you. It depends on how much you individually bring to the table. But it'd be hard-pressed to get me to go times your revenue, any multiple of your revenue. So you need to work yourself out of a job. Make it so the company can run without you, specifically operationally. It can acquire customers, it can take orders, deliver orders, take care of customers all by itself without you. Another thing you can do to build intrinsic value, like I did in my second company, is develop something of value, an asset, an intellectual piece of property that a company is going to value. That's another way you can build intrinsic value. But you have to build intrinsic value. You won't be strategic if you cannot build intrinsic value. And that takes years. You don't just do that overnight. So it behooves you to have an exit strategy that you're working almost from day one. So when it comes time to sell the company, some other things you should be prepared for. Know the value of your company. Know what's reasonable. That's a mistake that a lot of small business owners make, is that they ask too much for their business. They don't know what's reasonable. Nothing will scare away a buyer faster than if you dig your heels in and balk at an otherwise reasonable offer. You know, no one's going to want to deal with you if you're not going to be reasonable. So know what your value is. Well, how can you do that? Well, talk to some exit strategists. That's one way. But be careful. Only take their input as one data point. When I went to sell my second business, I talked to an exit strategist. And that exit strategist was trying to convince me that my business was only worth book value. And he could quickly hook me up with some buyers. But it was obvious to me he was just in it for the quick hit. He didn't know my market. He didn't know my business. He didn't know what my customers valued. He was not going to find me or help me with a strategic sale. So where do you find a strategic sale? That's easy. It's in your market. Know your market. You're going to be a strategic sale to one of your customers, to one of your competitors, to one of your bigger business partners. That's where the strategic sale is going to come from. In my case, it was a potential partner in my market that delivered services that my software package was designed to deliver, but they were using a different software package. I just happened along at the time that they and the company they were using split, and they were looking for a new software package. And here was an opportunity to actually buy and own the software by buying my company And that gave them strategic value, strategic leverage over their competitors. And so I was able to command a multiple revenue for that sale. My first company, they wanted to put me out of business. They wanted to eliminate me as a competitor. I was able to, same reason, in my market, direct competitor, reached out to talk about acquiring me. They were able to acquire me again for a multiple revenue because I was a strategic sale. So you will find strategic sales in your market, so know your market. Another thing you want to avoid is getting emotionally attached to your business. That's sometimes hard to do, but you have to know in your gut when the right time to sell is and when you can command the highest price. And again, not to be emotionally attached to where you expect more for your business than you're really worth. And that gets back to understanding the value of your business. So let's recap. The day will come when you're going to want to get out of your business. And you don't just want to walk away from it, and 70+% business owners end up doing just that. The most common way to exit a business is to sell the business. If you want to sell your business for more than book value, for a multiple of your revenue, you have to be a strategic sale. Where are you going to find a strategic sale? It's going to be found in your marketplace. Know your marketplace and know your value. How do you know your value? Talk to an exit strategist. Well, you can look at your balance sheet and know what your book value is. So that's usually the bottom, the floor of your value. But talk around and understand what strategic value you might have to your competitors, to partners, business partners you have, and also to your customer base. And know when the time is right. Sense the market. Someone's making a play. They're trying to expand their portfolio of offerings, and you would fit nicely in that expansion plan. Then's the time. Go talk to them. Might not be the time you were thinking, but maybe you have to accelerate. But you want to be in a position to be able to exit your business and be rewarded for all the hard work you put in for all the years. Otherwise, to walk away from a business is not much different than just to quit a job. If you like the content we're providing here, please follow us. And as always, if you have any questions, please direct those questions to info@brettscorner.com. I'll watch that email address and I'll respond to your emails. I won't respond to comments you leave on the video, so please use the email address if you have any questions or you want me to respond. And as always, thanks for watching.